Good morning, everyone. It's 9 a.m. here in New York City. This is Yahoo Finance Live. I'm Brad Smith alongside Julie Hyman. And here are the three things that you need to know on this Friday morning. Fresh inflation data hitting this morning. July's producer price index. Those are the prices received by domestic producers for their output. It rose 0.3% in July. That's higher than expected and goes against the narrative that price pressures are easing. The core PPI figure, which excludes food and energy, that also increased 0.3%. Comes after yesterday's inflation report showed price pressures continuing to moderate, but is it still too soon to declare victory? We'll ask Wells Fargo's Eric Nelson. Retail is the next sector to step up this earnings season. Walmart and Target are the blockbuster reports next week. The two biggest retailers in the United States have struck a cautious tone going into the numbers. Target forecasted downbeat second quarter, while Walmart said it was uncertain about the back half of the year. Despite signs the U.S. economy is slowing, Amazon's recent results, they suggest that the consumer is still alive. The question is, how alive are they? And a ticking time bomb. That's how U.S. President Joe Biden described China, as data points to a deeper economic slowdown. Speaking at a fundraiser in Utah, Biden's comments come the same week he signed an executive order limiting tech investment in the nation. China caught the market's attention this week with data showing deflation had officially arrived. Adding to the doom and gloom were double-digit drops for both exports and imports from the world's second biggest economy.
Well, fresh inflation data hitting this morning. July's producer price index, those are the prices received by domestic producers for their output, rose 0.3% in July. That's higher than expected. It also goes against the narrative to some extent that price pressures are easing. The core PPI figure, which excludes food and energy, also was up 0.3%. It comes after yesterday's inflation report that showed price pressures continuing to moderate on the consumer. But is it still too soon to declare victory? That's been the line from the San Francisco Fed's Mary Daly. In recent weeks, we spoke with her exclusively yesterday after that CPI report.
It is not a data point that says victory is ours. There's still more work to do, and the Fed is fully committed to resolutely bringing inflation back down to its 2% target. We don't control gas or energy prices or food prices, but definitely by bringing demand of the economy back in line with supply, we're going to get broader inflation relief. And that's going to be the thing that, I hear it mostly. I have 9 states in the Western United States. I can talk to any single person. I ask them, what's your number one concern about the economy? They still say inflation. More work to do.
So what is the bond market telling us about expectations on the part of market participants? There's been an expectations we were approaching peak yields, perhaps, with data supporting the idea the Fed is near the end of its hiking cycle. Joining us now, Eric Nelson, Wells Fargo Securities macro strategist. Eric, it's good to see you here. I first want to talk about PPI just briefly here because we did see it a little hotter. I know people usually pay more attention to CPI. What struck me, though, was not just the hot July figure, but the fact that the core June figure was revised to a drop of 0.1%. What do you make overall of this report?
Yeah, well, I think you have to sort of respect the different nature of this data. It's a little bit quirky. There's some stuff goes on with some of the margins and how they're measured. So it's a little tough to pull out and directly translate those data to the CPI data. And that may have been part of why you saw some of the downward revisions. But I think if you take a step back here and look at the overall trend in core inflation, whether you look at PPI, CPI, it's clearly lower. Question for me is it enough for the Fed to really take their foot completely off of the hiking pedal and even shift to the cutting pedal? I don't think we're there yet. Because really, in order for them to justify really cuts especially, you need to see a sustained return to 2% inflation. It's hard to get with where the economy's at right now. I think the reality is they need to see something softer on the labor market side, and they really haven't seen that yet to justify cutting. And I'm not sure we're going to get that for I'd say at least 6 months, maybe even longer.
Do you believe that the Fed would be cutting, or not cutting, but raising all the way until that 2% target? Or do you believe that there would be some additional policy implemented and then just kind of a wait and see if we get to some of those metrics? And perhaps on the other side, the risk if we see the opposite and inflation takes another spike higher?
Yeah, I think the Fed is hesitant at this point to just hike because they're not at 2%. They're definitely thinking about sort of the framework of real policy rates, right? where is headline policy rate versus core or any sort of inflation measure. And that's obviously high versus what they think our star is. They're not really sure. So I think the bias for them is to kind of stay around these levels, maybe hike one, maybe two more times, but they want to be very careful in calibrating that. The question, though, is what's the market pricing? And they're pricing in 6, 7, 25 basis point hikes through the end of next year. And the risk here is that those cuts aren't realized, right? Not so much that you see a significant reacceleration in the hiking. We think about the implications for broader markets.
Well, and what you've said in your recent note I thought was really interesting here is that right around when the Fed's last hike comes, that's when we start to see bond yields start to meaningfully decline. I guess the game here is trying to figure out when that last hike is, if it was at the last meeting or if it's going to be at the next meeting. But it is interesting, that historical marker here. So what do you think? Was it the last meeting? Is it the next meeting? When is that going to happen?
Well, official call from our economics team is that no more hikes from the Fed. I tend to think that there's risks for one more, and that maybe it doesn't come in September, but perhaps later in the year, maybe the November meeting. So that's why we're hesitant to call the top in bond yields. And if you actually look at the price action, yesterday is a great thing to kind of suss out where positioning is and how investors are thinking about the market right now. You saw a pretty soft inflation reading. You've seen generally dovish to balanced Fed speak. And the 10-year yield had a very hard time breaking below 4 yesterday and actually ended up quite a bit higher after some poor auction results. So that tells me that there's not a lot of comfort with peak yields here and that there's still some hesitancy around really piling into the long duration trade.
Well, Eric, what would change that? Is it just a matter of having to get past the next Fed meeting?
I think you have to see some sort of real weakness in the U.S. growth story. I thought that we'd be in recession by now in the United States. Obviously hasn't happened.
I mean, you and everybody else saw it pretty much.
Yeah. Yeah. Look, jobless claims are trending back down again. So I think you need to see something shift there. Labor market would be a big thing to watch, jobless claims, but also your monthly jobs reports. Could also be something financial, financial stability related, whether it's, the regional banking issues crop up again, maybe it's commercial real estate, whatever it may be. Something we're not seeing at this moment is certainly possible. But it has to be something significant on the growth side or the financial stability side. And right now that has not really come to fruition. So for now, we're thinking yields are not done rising.
Hey, Eric, just additionally on, the Fed's calculus here, when we think about some of the stickier areas of inflation, it's shelter, and shelter costs continued to show up. Home costs continued to show up even in the CPI report that came out this week. All that considered, should consumers expect that to abate or recede anytime soon?
Well, it's a great question because this was a huge theme last year, and I'm glad you brought it up because there's this narrative now that home prices and rents are reaccelerating, but to me they're more stabilizing than they are reaccelerating. If I look at the month-on-month changes in some of the private sector measures of rent growth, they've obviously picked up, but they're really just back to pre-COVID averages. So it's probably an overall good thing that we're not seeing outright deflation in rent. That would be maybe more worrying than anything else. You are seeing some more normalization. So that's it. I think that's something that I think the Fed and I think general U.S. consumers should be welcome to see. What you don't want to see have happen is a bigger reacceleration to something we saw in 2021 or 2022. That's obviously going to be a problem for those of us trying to rent, but also from the Fed's perspective and thinking about meeting their 2% inflation goal. But for right now, the shelter numbers are, I'd say, normal. What's more worrying is things like core services ex housing, which for right now are slowing, but there's some quirks in the CPI. Medical care is maybe dragging that down a bit. So really the underlying wage pressures is what we're trying to get at. And those just aren't slowing enough, I think, for the Fed to take comfort in where it's at on inflation.
Eric, stay with us for a second. We got another major topic that we want to bring to our viewers' attention this morning. China's consumer prices slid into deflationary territory in July. And as economic woes continue to cloud hopes of a recovery, President Joe Biden is calling out the world's second largest economy. Biden said China's economy is in trouble and fears the country is, quote, a ticking time bomb over its slowing growth and high unemployment rate. Now, that's according to a pool report of the Thursday fundraiser that took place. He went on to say they've got some problems, and that's not good because when bad folks have problems, they do bad things. Eric Nelson is still here with us. Okay, so a bit to unpack there, Eric, and perhaps we start with the data and what the data has been telling us from your perspective out of China thus far.
Well, it's not been great, Brad. I have to be honest. What's shocking to me about this whole thing, because you look at the activity data, you look at the credit data just this morning, the overall, I'd say, I'll call it the vibes from China's economy are not good. So I'd say what's concerning here is Beijing is certainly not taking the action it needs to, given the weak demand picture, the weak activity picture. And that's really concerning because you have a reopening economy here. We thought this was going to be the big growth story of 2023, and it hasn't come to fruition. If China doesn't do anything, the risk is you have a downward spiral here in activity, really predicated on this idea of the property sector being the lead sort of problem when it comes to medium-term activity. There needs to be some big action here from the central government. They need to counter the deleveraging that's happening in the private sector. And until that happens, it's going to be continued weakness out of China. I think even easing from the People's Bank of China, the central bank rate cuts probably aren't enough at this point. You really need to see something on the fiscal side to counter this weakness.
And we've talked to some other folks on the show who have said that even if the Chinese government does take certain measures, particularly with the property sector, that the dynamics this time are such that it might not even be as effective as it was in the past. So, if that's the case, what's the risk that they just if they don't do anything, or if they do something small, then what's the scenario?
Yeah, there's a lot of parallels being drawn to Japan in the 1980s and the bubble that burst there, given the extent of credit expansion that we've seen in the last 10, 15 years. And what's really changed here from a structural standpoint in terms of Beijing's priorities is deleveraging. This was never really on the radar for Beijing. If anything, it was leveraging. And that's what's concerning here about the sort of piecemeal, small steps the Chinese government is taking. It tells you that they're really trying to push this deleveraging, which is not the stance you want to see when you're looking for growth. Do I think there's going to be a real credit collapse here? It's certainly possible if China continues to sort of step back and let things happen. That was really, I think, that what people agree would be the policy mistake of Japan in the 80s and 90s was really not recapitalizing the banking sector, not taking swift action when it was needed. So even if that's the case, it's going to take a long time to play out. And I'm hoping that Beijing will be a little more proactive on the policy side before that. But that's the fear here, I think, is a real credit collapse.
So the other kind of thing about the environment in China, too, right now is the number of U.S. companies that had also kind of banked on projections that this would be a huge bounce back year, right? And so we're not seeing that in the data that's coming forward. So does that mean so much of the purchasing or the spend or that demand has been pulled forward and thus we're kind of just looking at a normal to perhaps slightly above normal environment? And then what does that mean for 2024 for companies who had kind of baked that into their forecast for this year and that are missing out on that?
Well, I think what's concerning here is if you actually look at the numbers, credit data this morning, a great example, you actually had the weakest loan demand since 2009 in the data numbers this morning. So it's not even as if we're just back to a normal rate of growth in China and that you didn't see the explosive rate of growth we expected. Things are really underperforming here. Mm-hmm. So that is the concern, I think. And when we take a step back and ask the question, well, what's it going to take for Beijing to step up and the government to really enact full big stimulus? I think you have to look at the labor market, unemployment rate. That has been actually pretty well behaved despite all the weakness in growth. And if you look at some of the PMIs, the services PMI just this past month showed employers are still looking to hire. So, with that backdrop, there's not a lot of urgency for Beijing to step in and take swift action. If that changes, though, and that will change if there continues to be credit deleveraging, that could be with a catalyst maybe for some real action here.
Hey, Eric, the other thing that caught my eye this morning was some commentary that President Biden made about China, where he called the economy there a ticking time bomb, or the economic problems a ticking time bomb. He criticized leadership there, as he has in the past. And so that makes me wonder sort of what the tension between the U.S. and China is going to yield in terms of perhaps exacerbating the economic pressure there. Is that something you see happening?
Well, I would say actually, if anything, the mood music between the two countries from an economic standpoint has gotten a little bit more positive. And that's welcome, obviously. Some of the spy balloon issues that cropped up a few months ago, seems like the two countries have sort of come to an agreement or can put that behind them. So generally speaking, the overall discussions have become more constructive. From a trade standpoint, the U.S. is still importing a lot from China, despite all the talks of reshoring, friendshoring. China remains a very important trading partner. So in terms of the hard data, the relationship is still pretty strong. And I think that in general is what's driving this continued positive movement in talks, the realization that the two are very reliant on each other. And I don't really see that changing materially anytime soon. So that does limit the extent of substantial financial market volatility from Chinese weakness, and also fallout to say the Chinese currency, for example. We think that's going to get a little bit weaker, but we're not in the 2019 environment where there's real big headline risk on the U.S.-China relationship, at least from my perspective.
Eric, thank you so much. Appreciate it. Eric Nelson, Wells Fargo Securities macro strategist. Have a great weekend.
Me too.
Thanks. The spotlight shifts to retail next week with several earnings on tap along with retail sales. We've got big box retailers like Home Depot, Target, and Walmart first up to the plate. And so we wanted to sort of look back at some of the tea leaves that we've gotten thus far, and then look ahead to what we could hear next week. Among the various tea leaves that we got in the past week was a big deal within the retail industry.
Huge.
In the form of Tapestry buying Capri for $8.5 billion. We talked to some folks about that. We've been sort of looking at what's been going on in specialty retail. One of the things, one of our sort of takeaways or themes that we've been seeing here is, and this has been a longer term thing, sluggish retail sales in the face of some of that spending going to services. And that seems to be continuing to some extent, although we've seen little glimmers of spending certainly on stuff.
Yeah, and it was exciting putting together our what to watch for this earnings season for retail specifically here, because one of the other areas too that has continued to be brought up, and hey, there you see our little cartoon faces, is the inventory. And we discussed this with Adrienne Yee. She brought this up in our conversation earlier this week, talking about how companies are needing to clean through that inventory. I believe we have a short clip of some of her commentary and what she's expecting this retail earnings season as well.
We're in the early phase of our wholesalers. We'll go into retailers. If they can hold on to the guide and basically, do the back half and get to those earnings and op margins with freight and promo recovery and below the top line, and then have top line on tight inventory, that's what the call is about for 2024.
And so the reason why inventory is so important is because of the promotional cycle we've seen companies have to deploy by not having that inventory marker correct. And so many of them are right sizing that kind of demand projection for what their inventory would look like. That's been key to making sure that there are more full price sales. Think about what you hear from companies like Under Armour, which already reported, and companies like Nike and many of the direct-to-consumer companies, the amount of the inventory that they're able to sell at full price. They're communicating that to investors. Adrienne Yee pointing out that earlier this week, and that tight inventory scenario that helps them out even further to ensure that they can hit some of those full price markers that they're looking for.
Yeah, inventory is also something that Simeon Siegel spoke about of BMO when we talked to him about the Tapestry Capri deal. And he also talked about sort of where we are after a couple of roller coaster years for the retailers. He said, in this moment, it's all about execution on the part of the individual retailers.
We're actually back to an environment where retailers can run their businesses. beginning of COVID, there was no supply chain, therefore there was no availability. So it didn't matter how good you were at predicting demand. You were at the whim of whatever product made it through the containers. That's no way to run a business. There's no winners and losers there. And then in the last year, it was the opposite, where everyone had so much excess inventory that it also didn't matter how good you were at predicting demand. You were just overflowed with this product that you had to move. We're back to normal. And again, that's a hard thing to say because what is normal? But we're back to an environment where I think the companies that are really good at understanding their consumer and predicting inventory accordingly will win.
So that's kind of interesting, right?
Yeah.
Is that these retailers are no longer going to be subject to the winds of supply chain dynamics and consumer dynamics as to the same degree that they were over the past couple of years. It's going to matter more about how the management teams are doing when it comes to these companies. Now, that said, the first theme that we talked about, sluggish retail sales, perhaps in the face of services spending, was highlighted by a couple of charts that we got from the Bank of America Institute in their monthly look at consumer spending when it comes to retail. And one of the things they looked at was the boost that we saw around the July 4th holiday here, but they compared 2022 to 2023, and we are seeing 2023 run at a little bit of a higher rate here. So that's something that should be encouraging perhaps when we await those overall July retail numbers. And they also have been tracking retail excluding restaurants and services including restaurants, and basically we are seeing those two sort of come back into line, which suggests perhaps a little bit of a resurgence in goods spending in line with services spending, which is intriguing. You know, who knows if that's what we're going to see writ large coming from these retailers and coming from the retail sales numbers.
It's particularly interesting on the credit side of the spending equation, too, because if there's one thing that we've talked about time and time again, consumers may not be breaking right now, but they certainly are pivoting how they are spending and where they're deploying cash that might be on the household balance sheet, or perhaps tapping to pay or swiping to pay that much more quickly because they know it's something that maybe they can pay off just later on down the line for a purchase that they want or maybe need right now. And that kind of contributes back into the data that came out of the New York Fed and how some of the household debt and credit report that they put forward. Right now, we're seeing credit card balances saw growth rising by $45 billion to a series high of over $1 trillion right now. And so that coming out from the New York Fed, you pair that with what some of the larger companies that are going to be reporting are already saying about how they're engaging with consumers. It's how the consumer is spending, but also where that spending in the guidance might dampen further. And so I'll just wrap on this. The impact of student loan payment resumption, that continues to come up in analyst conversation right now. Could be something that impacts the guidance going forward.
Yes, both the sort of student loan repayment buzzword and the excess savings buzzword are really going to be important for the outlooks for retail and services spending, for that matter. Just how are people spending money as they maybe have less of it? We'll see. All right, we got much more markets action coming up, including the opening bell. Stay tuned. You're watching Yahoo Finance.
It's been a wild year in the retail space. Inflation has dominated the headlines, causing shoppers to spend more cautiously.
As a result, profits at major retailers such as Walmart, Target, and others have come under pressure.
Organized crime and a growing list of bankruptcies also continue to cast a shadow over the entire industry.
But what does this all mean for the future of the sector? Should investors dive in or steer clear of retail stocks?
We'll bring you key analysis and hear from some of the biggest names in the industry to answer key questions.
Who is the consumer visiting? What can retailers do to stop the rise in theft? Are more bankruptcies on the horizon? And where does AI fit into it all? It's all part of our week-long special, Retail Evolution, The New Era, starting Monday, August 14th, right here on Yahoo Finance. You won't want to miss it.
We got some market movers for you right now, starting with Olaplex. Those shares are down in pre-market trading by almost 1% after Canaccord Genuity Susan Anderson downgraded the stock from a buy to a hold. Anderson also slashing its price target from $5 a share to $3 over the company's weaker second quarter sales. They were down more than 48%. When they reported them, I believe earlier in the week here. Olaplex to me has been such an interesting story, right? This was one of those sort of touted debuts that we saw back in 2021. The stock came public at $21 a share. You see it's trading under $3 today because this stuff was supposed to be revolutionary for your hair.
Really?
Sure.
I've never tried it yet. I got to give it a shot.
It's this. Originally, their initial product was a conditioner. It was mostly used in salons before they started selling it retail, and sort of a hair mask, if you will, that was supposed to really rejuvenate your hair. And like a lot of sort of, I don't know if I want to say faddish products, but ones that had a lot of consumer enthusiasm. The enthusiasm ended up fading over time. People complained if they used it too much or for too long, the effects it had on their hair over time. Again, that's sort of anecdotal, but nonetheless, it definitely lost some mojo.
Well, I'm looking at some anecdotal evidence on my screen right now, at least according to some beauty influencers who have tried the product that I use actually and switched to Olaplex number 6. So interesting. Perhaps I'll take a look at that after the show. But the stock, like terrible movement that we've seen over the course of this year.
Yes.
And then we were taking a look at that max chart. I believe it's down more than 80%.
There were also at one point some alleged fertility concerns that were, I believe, associated with the products sold in Europe, but then the company said, no, that's not really an issue. So that also had an effect on sales. Right,
and factored in actually to this downgrade from Canaccord Genuity as well. Anderson says that near-term EBIT margins are under pressure as Olaplex invests in marketing and fighting misinformation around its products, to your point there a moment ago.
Yeah, exactly. So whatever the case is, the company has taken a hit. And so is the stock. Yeah. We are coming up on the opening bell in just a few moments here as we look at the last day of the week here, consider some of the yield action that we've had recently, and as people continue to weigh what the Fed has been up to and what it may be doing next. So look at that, Delmonico's, the steakhouse.
Yeah.
I don't think that's a publicly traded company, is it?
But it's around the corner from the New York Stock Exchange. Great old-fashioned, I will say, by the way. Very expensive French fries, though. The frites, too expensive.
But probably delicious, I would imagine.
Truffle ones.
So Delmonico's there celebrating steak at 9:30 in the morning, and Manhattans, perhaps, or old-fashions, excuse me, for that matter.
Yes, both.
So the opening bell on Wall Street. Let's do a quick check of the market, sponsored by Tasty Trade. We've got a lower open here this morning. Looks like we are setting up for the second straight down week for the S&P 500. It was down 2.25% last week, coming into today off about 1/5%, and the S&P is falling another 0.4% today. We've got the Nasdaq leading declines off about 0.75%, and the Dow down about 0.15% here about 59 points.
Yeah, let's put some meat on the bones of these arrows that we're watching here out the gate this morning. As you're seeing, the Dow Jones Industrial Average right now lower by about 0.2%. Past 3 months looking good over the course of this week. As you were mentioning, the 5-day move flat just barely to the upside. We'll see if we can hold on to that gain there. But as of right now, not looking too good. Nasdaq Composite, you're seeing that down 0.7% or 0.75%. Past 5 days, down nearly 2%. S&P 500, you're seeing that also over the past 5 days lower by 0.7%. S&P 500 here out the gate, down 0.5%. Since we mentioned the S&P 500 and the 11 sectors that we always take a look at.
The action today, Brad.
Oh, you okay over there?
No, just sneezing.
Oh,
I'm
goodness,
fine.
bless you. Also, let's take a look at XLE here. Let's take a look at the intraday activity actually here, and you'll still find XLE leading the pack. It's up by about 0.2% right now. Utilities also the only other gainer. However, technology, that's down by about 0.9% and leading some of the sector-based declines right now. Speaking of technology, we've got the tech-heavy Nasdaq 100 here for you on screen. All right, sea of red right now. Let's see where we can find some green perhaps as we want to end on a positive note for the week. eBay might be able to do that. Right now you're seeing that higher by about 0.8%. All right, that's not going to cooperate, but hey, maybe we can take a look at JD.com. That's pulling up the caboose on the Nasdaq 100, down 5%. We have had some interesting e-commerce data out of China over the course of this week. JD.com, no doubt one of the larger names that is certainly in that sphere. So just because they haven't wrapped me yet, we're also going to take a look, little bonus chart here, heat map for you, and perhaps they did and I just can't hear them. The Dow 30 components as of right now, you're seeing Apple down by about 0.3%. It's been a rough go of it. Just heard the wrap, so we're going to wrap with a 5-day look at the Apple component in the Dow 30, and right now, over the past 5 days, that's down by about 2.7%. Let's actually pull that back to last week just to see how it's moved since earnings, down 8% roughly since that earnings report that came through from Apple.
Yeah, and I'm seeing JD, by the way, reports on August 16th, so that'll be the next catalyst for that one. Let's take a look at some other movers here. Virgin Galactic shares are looking for some altitude. This after the launch of its first space tourism flight. Its VSS Unity rocket plane carried 6 individuals, including a former Olympian and the first mother-daughter duo to go to space together. Worth noting, the flight was suborbital, but allows passengers to experience several minutes of weightlessness. And Virgin Galactic's already saying that it's planning its next one.
It is September. Do you remember? We'll see if it happens in September for them. But ultimately, that is what has been set forth for Galactic 03. This was Galactic 02. Some of the, of course, benefits, or at least some of the successes that they found from that flight. And these flights, these tests, are extremely expensive for the company. However, they said that the Galactic 02 mission achieved multiple historic milestones, showcased how Virgin Galactic space flights are broadening access to space for a diverse global community of astronauts here. That diverse global community of astronauts is going to need to have some diverse global money as well, because these are not cheap flights for consumers to take. However, at least in the test cases, I think what they're trying to prove continually is that they can take people to the edge of space, and for a range of different type of personas that are going and making some of these voyages, if you will call them that. They've been able to achieve the first Olympian to go to space, first majority female space flight, the 6th and 7th black women to go to space, and the second person with Parkinson's to go to space as well in Galactic 02.
Well, and I think part of the reason that the stock is rallying today is relief, right? Because there have been a lot of delays with their earlier flights. And so when you look at that stock chart year to date, it is really all over the place because, oh, it's going to go. No, it's not going to go. We're going to pull it back. You know, so it's been a lot of back and forth. So not only did they just have this flight, they're now immediately saying, okay, we're going to schedule the next one. So interesting here. And the shares, by the way, they were higher. Now they're off by 1.5%. So speaking of sort of up and down, I don't know.
Yeah, investors trying to make up their mind on this one.
Yeah.
Let's see what they're doing on Cano Health as well. That's been moving this morning. We've been keeping tabs on that. That stock, all right, well, why? Well, yeah. You see that one plummeting. That's down by about 51% after the company missed the street's revenue expectations for the second quarter. And here's the thing. They also announced that the healthcare provider is exploring a potential sale. The company said in a statement that that their amount of liquidity is not sufficient to cover the company's operating, investing, and financing uses for the next 12 months here. Shares down 55% over the course of the past 5 days, 51% today, though.
Yeah, so the company's tried to sell itself before this, a primary care provider. It's tried to sell itself to CVS. Those sale talks fell apart earlier in the year. And accompanying this going concern statement was also the company's latest financials. TD Cowen said the fall in second quarter EBITDA was stunning here. EBITDA actually had a loss of almost $150 million. Analysts had been looking for a gain of $12 million. So an unexpected loss on an EBITDA basis there. Total revenue at about $767 million, well below estimates as well. So that the sort of performance and financials of the company accompanying this going concern statement, it's one of the top tickers, I believe, on our platform today.
Yeah.
And another one of those that came public in the past few years.
MRA is what investors within this would want to remember, even as they evaluate Cano, because Medicare risk adjustment is what's impacting this company. It impacted their net loss. Net loss came in most recently for their second quarter 2023 financial results. Net loss was about $270 million. You compare that to a net loss of $14.6 million in the year prior, and that was driven by higher operating loss due to what they said was lower than expected Medicare risk adjustment revenue, higher third-party medical costs, and a change in reserve for other assets. But that Medicare risk adjustment also made itself known with regard to the revenue per member per month. That was 19%, down 19%, driven primarily by those lower than expected Medicare risk adjustment revenues as well. And that is essentially, the amount that Medicare will pay out based upon the risk scores of some of the members of a program.
Right. Well, the dynamics not looking good for them.
Not
clearly.
good. Yeah. Well, let's talk about Ford as well this morning, because this one has been interesting to track. Tensions are growing between car makers and the United Auto Workers Union, causing Ford and others in the sector to slide on Thursday. Concerns are now starting to rise that a strike could be hitting the auto industry should a contract not be agreed upon next month. Yahoo Finance's Pras Subramanian has more on this story. Pras, great to see you this morning. What do we know?
Hey, Brad. So yeah, it's Ford, GM, and Stellantis, the big three that are in the sort of crosshairs of the UAW. It seems the union is really gearing up for a fight here, demanding better pay, better pension, fewer work hours, and among other things. So, an analysis done by Bloomberg found that these demands over the course of, say, a 3 or 4 year union contract could cost the big three around $80 billion. In lost profits. But, on the UAW side, the union says that they took a lot of sacrifices after the great financial crisis, took a lot of sort of concessions there to keep these automakers alive, and they haven't been paid back for them over the years. Meanwhile, the big three have sort of had record profits for the last few years, and even GM and Ford just this past few weeks upped their profit guidance for 2023. So there's a big fight going here where the unions are saying we need to be paid more, and the automakers say, hey, we got to be competitive versus the Teslas and the Kias and Hyundais that don't pay union wages. How are we going to compete against them? So it's a big fight, and we'll see who blinks first come September 14th, when that is the date of the union contract goes out of as it expires. Hey,
Pras, stay with us for a second, because also in the Europe EV space separately, we're seeing some German automakers being hit hard due to semiconductor shortages. How's that playing out?
This has been sort of a story that's been going on for some time now, and it's not a surprise that in Germany, the report out of Reuters said that an Audi executive said that the chip shortage in Germany could cause bottlenecks that could extend for years. Like I said, this has been happening for a while there. It's not breaking news, but like the Germans in particular have been hit hard by this. They don't actually have that much local manufacturing of chips, and that's a problem for them. Porsche in particular had to scale back production of the Taycan EV, among other cars, because of the fact they lack chips. Now, chip plants are actually coming to Germany now. Intel, a company that's going to build a plant there, but those won't come online for years. So right now they're going to have to sort of rely on outside sources, import those chips, but it sounds like they're struggling to do so. And some studies have found, Brad, that the European automakers in particular have lost around 200 billion euros in revenue due to the chip crisis over the past few years.
Pras, I saw a Lamborghini parked outside the office. I assumed that it was yours, but do correct me if I'm wrong there. I just know that our autos reporter, he rolls in some very, very classy and fine automobiles as well here on
That was certainly not me.
Not yours, okay.
I get to borrow my girlfriend's Subaru Outback, so that's what I got. So
it's close. It's close to a Lambo. Win Lambo. You answer that question for us at your own convenience. Our own Pras Subramanian. Thanks so much, Pras. Appreciate it. All right, guys, we got all your markets action straight ahead. Stay tuned. You're watching Yahoo Finance.
Again, since you're a Texan, Hire the hair closer to God? Are we a proponent of that? Your hair isn't that big, but it looks beautiful.
You should have seen me in the 80s in high school.
Nice.
It was, yeah, absolutely.
Love it.
Well, some investors are pulling money out of the stock market and shifting towards cash and bonds, according to strategists from Bank of America. Yahoo Finance's Jared Blickery joins us with more from the New York Stock Exchange. Jared, name them. Who are these investors?
Well, I'll tell you what, healthcare is seeing inflows. Not a lot of else looking at equities, at least in terms of inflows this week, but strong inflows into cash. Money market funds still growing pretty strong inflows, $145 billion into cash quarter to date. Michael Hartnett over at B of A talking about the flows this week. Faster inflows than in the last quarter, which is also big, by the way. Treasuries, so those are government bonds, strong inflows, $127 billion year to date, on pace for an annualizing record of $206 billion. So lots of money going into defensive areas like cash and treasuries. Credit, there's money moving out of high yield bonds. That's the riskier part of the market. You can put that on par with equities. And then EM, biggest debt outflow in 6 weeks. And then finally, we get to healthcare, where we're seeing largest inflow since April of this year, $1.4 billion. Not earth-shattering, but we'll get to some charts in a second. Just want to go over some of the headlines from Michael Hartnett. He's saying 3% CPI, U.S. Treasuries annualizing record more than $206 billion. China deflation, yet we have the 10-year yield over 4% in the U.S. Debt, fiscal, labor, geopolitics. Cost of capital ain't fallen without a hard recession, and stocks suddenly stuck. So basically saying that there is a pain trade to be had sometime in the future when there's a rapid repricing of all of these risks. Now, let's go to the Wi-Fi Interactive, and I'm going to show what's been happening this week. It is a down week, especially when we look at the Nasdaq, which is leading the way down today. 5 days down about 2%, just kind of seesawing its way lower. Let's take a look at the Dow, actually closing out the week with minuscule gains there. And just to round out the price action, S&P 500 down about 69 basis points. But let's take a look at a longer picture in the market. This is the S&P 500 year to date. I'm going to show you that it's very close, that it's creeping down into its 50-day moving average. That's that blue line you see right there on your screen. If you take a look at the Nasdaq is just below it right now. Russell 2000 pretty much there as well. And take a look at Philly Semiconductor Index here. This is actually below. I think the semiconductor is kind of the canary in the coal mine, especially NVIDIA getting hit yesterday with respect to the AI trade. So that's where I'm laser focused. Apple fell first. We take a look at, this is the 5-day price action. Apple's down 2.8% for the week. Let's get a 3-month candlestick chart so we can see the decline. And as I pointed out earlier in the week, we haven't ever seen a decline like this from a record high in this quick a period of time. So lots of interesting things going on here. Can the market rally without Apple's participation? Absolutely. We can see cyclical and values pick up. Energy has been a really bright spot this week. But if Apple is crashing, if Tesla is crashing, especially in terms of sentiment and the negativity that brings to the market, it's difficult to see the S&P 500 advancing with some of those big leaders crashing. Here's the spider S&P 500 sectors on a 5-day basis. Energy is the leader here, up 2.3%. And just take a look at over the last month. Energy is also the leader there, 6.9%. As I pointed out, I believe yesterday, you take a look at a max chart. Let's pull that up one more time. We're going to see Energy XLE at a huge potential triple top, but trying to break free. If it breaks out of a 15-year consolidation, look out above, guys. But that's where the action seems to be right now in the energy sector.
We will keep on watching that. Thanks so much, Jared. Appreciate it. Well, China's been a big focus for investors this week after the country saw consumer prices tick lower for the first time in 2 years. President Biden calling China's growth concerns a ticking time bomb at a political fundraiser. Our next guest remains skeptical of some of the numbers we are getting out of that nation. Kenny Polcari, Case Capital Advisors managing partner, is with us now. Kenny, it's great to see you. So what do we make of all of the China data and the China rhetoric and what it means for investors here in the U.S.?
Listen, I think you have to be very careful when you go into China because the rules can change from moment to moment, right? So you never really know what you're getting. They're telling us one day that the China economy is expanding. They tell you the next day China economy is declining. Then they tell you China's buying oil. Then they tell you China's not buying oil. And so they create all this chaos. So I actually do not invest directly into China just because I don't want to add that chaos to what else I'm doing. I have exposure to China through things like Apple. But therefore it's controlled by Apple, right? Not so much by what the Chinese want to do. So I tend to stay away, but that's me personally. There are people certainly that find opportunity in China, but I think you have to understand going in that it can be a very volatile investment part of your portfolio.
But even your Apple holdings would still be impacted by whether or not China decided to put more liquidity into the economy and into consumers' hands and their spending propensity as well, yeah?
Agreed. So therefore, I do have some exposure to China, but I like to think because I own Apple, it's really a U.S. company. While it may respond to what's going on in China, that's different than China being able to go in there and change the rules on Apple or change the way they can in Chinese listed companies, right? Where they can suddenly just decide, this isn't going to happen anymore. We're changing rules. They can't really do that to Apple. And by the way, even though Apple depends on China for a lot, they are starting to, and we've seen it ever since COVID, they are starting to broaden out their supplier base, whether it's Vietnam, whether it's India, other parts of Asia, so that they're becoming less dependent on what happens in China.
Kenny, I want to pivot, if we could, you mentioned oil in passing with reference to China. We just heard our Jared Blickery talking about it. You also have been writing about it in your morning notes. Oil's been creeping up. How much of an issue is that going? It hasn't seemed to be much of a problem for stocks, but will it be?
Well, oil stocks certainly have done well, right? With oil creeping up, it's up 25% just from 2.5 weeks ago when it was trading down at $65. It's now trading at $84. and likely probably going higher. We see that the production cuts by the Saudis and Russia are starting to take hold. We see global demand increasing. In fact, I put it in my note today that Bloomberg ran with an article about how global demand is robust. And actually, China's buying plenty of oil. So this whole idea, once again, about China, is kind of conflicting. But one way or the other, at some point, yes, if oil becomes way too expensive, is it going to hurt our economy and then therefore hurt the market? Potentially, yes. So I think you have to be careful going in, but that doesn't mean you should panic and start selling everything. It just means you need to take advantage of the opportunity that's going to create in other sectors of the market.
Is there any different way that investors should be playing kind of the international equation going into 2024? Now that we've essentially got a quarter and a half left in 2023, a lot of people are going to start paying attention to what is 2024, and that is a general election year here in the U.S.
Yeah, it's going to be, there's going to be a lot going on. I tend to in terms of international markets, I tend to favor European markets versus the other markets, versus the Asian markets, China, Hong Kong, any of that. My exposure is in international is in Europe. Now, I do think, and I like Europe, the UK has been underperforming this year. If you look at the list, the UK is only up 1% on the year, while all the other markets in that region are up double digits, right? From the Euro stocks, Italy, Spain, Germany, France, they're all up 13 and 14%. The UK is lagging way behind. Now, part of that is the economy in the UK. I get it. Inflation is sticky. The BOE remains hawkish, the same way the Fed is going to remain over here. But I think you have to be selective, like anything. I don't think you can just passively go in and buy the market. I think you have to really look and find the sectors that you think, like here, are going to do better in a rising rate environment. Those would be names like consumer staple names for me, banks, and healthcare. Whether it's here or whether it's in Europe.
And what about the market overall here? Because as you've been rating recently, maybe the market's a little tired. We've seen evidence of that over the past couple of weeks. We've already seen stocks drop a bit. Are we going to see more of that?
Yep. I think we are. Look, you know as well as I do that this tends to be a seasonally kind of volatile, weak time of year, August into September, maybe even so much into October. I don't think the market's going to crash at all, but I would love to see the market back off, 7 or 8 or even 9%. Because remember, anything within a 10% range is well within the normal range of trading. The issue that I think we're going to find is as the market starts to back off, I don't think it's going to back off enough because there's a lot of portfolio managers that went to cash expecting the Morgan Stanley S&P 3000 call that never came. And so they're sitting there with plenty of cash that they have to now put to work. We're in the second half of the year. Markets are already up double digits, and these guys are lagging. So therefore, I think any dip is going to be bought. Unless, of course, the economic data should suddenly change so drastically that it would change the narrative, which I don't think it's going to do. So yes, I think the market is going to back off, but I don't think I'm not looking for a crash. If we move, 6 or 7%, I'd love to see that. And we're already down. Well, the S&P is already down 4% from the highs 2 weeks ago.
Yes, exactly. We've seen kind of a rapid deceleration here. As always, I like to end with talking about your daily recipe. Today, it's another pasta one, pasta, zucchini, and guanciale?
Guanciale. Yes, it's like the fat from the pig's cheek, right?
Yes.
But now, if you don't have that, if you can't get it, you can always use bacon. But one way or the other, it's a simple recipe, and I put it in my note, right? You want to saute the guanciale first, make it nice and crispy, take it out, leave the fat that's left behind in the saute pan. Take your zucchini. I would use green and yellow because it's colorful, right? Cut them in half lengthwise and then cut them this way so you get like these half moon shapes. Put that right in with the in the saute pan. Saute it up. The zucchini will make its own water, right? Boil the pasta, make it al dente. I would use penne rigate with this one, like kind of the short pasta. Then when the pasta's done, put it in with the zucchini, then add back the guanciale, toss in a couple of handfuls of pecorino romano cheese, toss it up and serve it immediately. It is delicious.
It sounds delicious, I gotta say, Kenny.
The whole thing takes you 20 minutes, start to finish, so it's also easy to prepare.
And I appreciate the last time you took a little bit of recipe advice from me, which was an honor, I have to say, and then you put out a recipe.
Yes, I did, and I actually gave you credit for letting me, think about that because it was perfect, right? It was your idea.
Thank you so much. I appreciate it. I don't have any inspiration for you today, I'm sorry to say, but I will next time. I'll know the pressure's on. Kenny Polcari, Case Capital Advisors, managing partner. Great to see you as always. We got much more coming up. Stay tuned. You're watching Yahoo Finance. We always like to ask people who come into town from out of town kind of about the vibe, right? Because most of the people we talk to are based here in New York. You, of course, are based in Houston, Texas.
Right.
What are you hearing from clients right now that might be different than what we're hearing, say, on the coasts?
Well, I think it's more of a question of the conservative nature of their portfolios, the risk that they're willing to take. I feel like there's some differences there. Some people that see more of a recession that's coming, other people that feel we're having a soft landing. There is a dichotomy going on there between clients, and it affects the risk that they're willing to take in their portfolios.
Another blockbuster deal in the retail space this week after Tapestry announced it would buy rival Capri Holdings in an $8.5 billion deal. Stay tuned for our executive editor Brian Sozzi's interview with Tapestry CEO Joanne Corvoiserat. That's coming up at 10:30. You don't want to miss it.
All your markets action straight ahead. Stay tuned. You're watching Yahoo Finance.
Do you have a favorite stock right now? Like top pick?
So we like Adobe, actually. A lot of people like the tech space, and they're looking at some of those big names that have actually pulled back. Adobe's a way you can play the AI space, but at a cheaper valuation and a name that can be in your portfolio for the long term.
Welcome back. It's just after 10 a.m. in New York City. This is Yahoo Finance Live. I'm Brad Smith alongside Julie Hyman and Rochelle Akufo. We are about 30 minutes into trade here on the day. Let's take a look at how stocks are moving right now. The S&P 500 lower this morning as investors continue to weigh the path of interest rates after inflation data this week. July PPI coming in hotter than expected this morning. We're also looking at shares of Mercado Libre. That stock beat on its earnings last week. And this morning, analysts from Citigroup lifted the price target for the company to $1,550 from $1,500. Credit Suisse also upping its target for the company, and on Thursday, it announced it will appoint Martin de los Santos as the new CFO.
Let's also take a look at Stanley Black & Decker. Wolf Research just downgrading the company to underperform and issued a new price target of $94. Analysts cited the toolmaking company, saying the toolmaking company has less room to see gains because of its current valuation and that the stock is benefiting from investor optimism that the market for newly built homes has bottomed. The shares off 1.5%.
And shares of Carvana falling after Morgan Stanley analyst Adam Jones maintained his underweight rating on the stock. While Jonas did raise his price target from $35 to $37, the analyst sees significant challenges ahead for used car consumers and Carvana's long-term business model as well.
Well, we just got consumer sentiment numbers breaking from the University of Michigan, coming in at 71.2. That was unchanged in August compared with July. If you look under the hood at some of the other parts of this, the expectations index ticking down to 67.3 from 68.3 the month prior. Current economic conditions ticking up to 77.4 from 76.6 prior. So people feeling a little bit better about their current status in August than they did in July, but really not seeing big swings here or changes in consumer sentiment.
Yeah, some of the additional color here, the consumers perceived few material differences in the economic environment from last month, but they saw substantial improvements relative to just 3 months ago. Of course, that larger trend, what investors should be keeping a close eye on, as well as where the Fed might be monitoring where consumer sentiment continues to come in at too. But long run inflation expectations, those remain stable as well at 2.9%, staying within that narrow 2.9 to 3.1% range for 24 of the last 25 months.
And of course, this is coming ahead of a big week that we're going to see in retail earnings as well, trying to get a gauge on the consumer, trying to figure out which of these companies are really getting an understanding of where the consumer is, how they're downsizing in some ways, what they're sticking close to in terms of brand loyalty as well. So a lot of nuance to keep an eye on here as we get ready for that big week of retail data as well.
Absolutely. Well, Fresh, go ahead.
I was going to shift gears here because that fresh inflation data hitting this morning. July's producer price index rose 0.3% in July. Now that's higher than expected and goes against the narrative that price pressures are easing. So where are we on inflation? Let's bring in our very own Jennifer Schonberger to discuss this more. So after we already got CPI, now PPI painting another different picture here.
Hey there, good morning, Rochelle. Yeah, a little bit of whiplash on the inflation front, right? Wholesale prices clocking in a bit hotter than expected. That producer price index, which really measures the prices that businesses get for its goods, increased 0.3% month over month versus the 0.2 expected on a core basis. That strips out the volatile food and energy prices. Looking at that year over year, clocked in at 2.4% versus expectations for 2.3%. And if you take out trade, July saw the largest increase since February. Now, this morning's reading on producer prices comes a day after the consumer price index showed inflation continued to cool in July, slowing to 4.7%, stripping out volatile food and energy prices, down from 4.8% in June and down from 5.5% earlier this year. Though that CPI number not enough to convince San Francisco Fed President Mary Daly, who told me in an exclusive interview on Thursday that while the CPI number was good news and inflation is moving in the right direction, there's still more work to do to bring inflation down. Daly telling me she's highly data dependent before determining just how much more to raise rates because there's still a lot of data to come. Of course, this morning's PPI underscoring her point.
Whether we raise another time, hold rate steady for a longer period, those things are yet to be determined. And it would be premature to project what I think would happen because there's a lot of information coming in between now and our next meeting.
Now, Daly says she really needs to see services inflation, excluding housing, come back down to pre-pandemic levels to convince her that inflation is back on course to the Fed's 2% target. We are going to get a couple more readings on consumer inflation before the Fed's next policy meeting on September 20th. Guys,
I'm sure everything will be clear after we do. Jen, thank you so much. Appreciate it. Well, as we've been talking about, the markets have been trying to price in a lot of data lately. Central bank policies as well, earnings, the latest CPI and PPI reports, the jobs report. To some investors, the data seems to be pointing to a soft landing as the Federal Reserve continues to fight high inflation. To others, like our next guest, we may see a longer path down to that coveted 2% target. Let's bring in Mizuho Securities USA U.S. Chief Economist Stephen Rizzuto. Stephen, good to see you. Thanks for being here. Pleasure. It is hard to synthesize all of this data and come up with a clear picture. And I did see some commentary recently from Alan Blinder, formerly of the Fed, who said the stuff that's happening now in the economy is not really even because of the Federal Reserve, right? Because there is this long and variable lag, we still have quite a while to wait before the bulk of their increases actually hit the economy even.
Well, the reality of the situation is we're in the window where it should be happening. You can't say there's that much longer to go. If you're in the window and it's not having the effect, and if you look at the things like the Atlanta Fed nowcast are suggesting the economy is actually accelerated into the third quarter of the year, that really goes to suggest, well, Alan, maybe you're missing the calendar here. There's something fundamentally going on in this economy. What's going on in this economy basically is the forward structure of rates is anticipating that the Federal Reserve is going to cut rates. And typically in a tightening policy, the markets are not this forward thinking. So the yield curve, the spread between, let's say, the 2s and 10s, most of the inversion happens from 5s to 10s. This time it's from 2 to 10s. Almost all of the inversions between 2 and 5s. What this essentially means is where consumers fund, basically in the securitization market, is not having the effect that it normally would have, because the markets are looking through and saying, this isn't going to last long. So it's not having the effect. And that's really the problem. It's kind of like I'm giving you a drug, but then I'm giving you half of the counteracting drug and expecting that to cure you. It's not, and that's the Fed's problem.
Is the current structure of the economy screaming soft landing right now?
I think the current structure of the economy is suggesting that inflation's bottoming out. And it's bottoming out at a target, at a level well above the Fed's target. You look at the CPI number yesterday. To me, the most glaring aspect of the CPI was the goods prices are declining, service prices are rising. Goods prices are declining because the global economic backdrop is not good, which then goes directly to the point of, well, if I look at the equity market, okay, there's no pricing power that's going to be left in a lot of these companies. So if there's no pricing power and I had 2% growth in the economy and I had some pricing power in the first part of the year and I still had a decline in earnings, how am I going to get 11 to 12% rise in earnings next year with less pricing power and supposedly less growth? So there's a lot of contradiction that's built into these things that are keeping things that need to happen from happening. The forward structure of rates is keeping consumer spending from slowing. The equity market is actually keeping CEOs in a position where they're capable of hoarding workers. That's the next conclusion.
And Stephen, Rochelle here. A couple of meetings ago, we heard from Fed Chair Powell that the risk of doing too much was still better than the risk of doing too little and having, persistent inflation continue to permeate here. Is that still the case, though, given some of the recent data?
No, I think that's definitely the case. I mean, the Federal Reserve has a 2% target. The PPI numbers accelerated quicker than the CPI numbers. They turned quicker than the CPI numbers, and now they appear to be bottoming, which suggests the CPI numbers are going to be bottoming. And if you bottom out the CPI numbers in that 4% area on core, you're double what the Fed's target should be. You've got a lot of work left ahead of you, and the answer is this economy is not feeling the impact because the nature of the economy has changed. Nobody funds at the front end of the curve anymore. Everybody funds in the belly of the curve and at the longer end of the curve, and those markets haven't moved anywhere near as much as the Fed funds rate has, so the amount we have to get out of the Fed is greater because of the different structure of the markets and the reaction function in the markets to what the Fed is telling them.
So does that mean, something's got to give here. Does that mean that the Fed is going to raise more than one more time, A? Or B, does it mean they're going to change their inflation target?
Well, they can't change their inflation target because credibility goes out the door. Right. You want to change your inflation target at this point, you just sit back and say, okay, where's the 10-year going to go?
But also raising more than one more time is not a great scenario for their credibility either, is it?
Well, it is, because they say they're data dependent. And if the data isn't there, and I don't think it will be there, they will raise more than one more time. This concept of betting on where the terminal rate has been wrong all the way through. We started at 100 basis points, we went to 2, we then threw in the towel and said 350. We're now at 550. And we're still not there. So this guess of what the terminal rate is against the backdrop of this is a very different market environment that then influences the economy. Part of the problem is the Federal Reserve's dots in their SEP. They're telling the market you're going to get a soft landing, so the equity market priced in a soft landing. They tell the market, oh, we're going to be cutting rates next year, so the market prices in that they're going to be cutting rates next year. But then in their rhetoric, they have this conversation of higher for longer. So which is it? They're conflicted.
Well, but if I may, it's not just the market, and it's not just the Fed that is sending the message of the soft landing, it's the actual data is sending the message of consumers are sending the message of soft landing too, aren't they? The data is telling you the economy is doing well.
Right. If the economy is doing well and you have a 3.5% unemployment rate and you've got wage demands like the ones we're hearing about over and over again on channels like yours, you're beginning to ask the question, how are they going to get to 2% at this level?
Sure.
Right, that's their problem.
Yeah.
And the reality is that implies higher for longer, with the reality of emphasis on both higher and longer, and the market's not appreciating that. Neither are bonds nor are equities, which opens up the possibility of a hard landing rather than a soft landing.
Is there a risk next year, considering the amount of policy that's still going to overflow into next year, an election year, where, of course, there's been the kind of separation of powers that we do know that President Biden and the administration have been trying to set forth and kind of make that clear to the consumer environment right now. But does that still run a risk of kind of bleeding over or permeating over or muddling of where there could be influence?
Unfortunately, the fiscal policy path that we have gone down is basically out of control. Okay, we have a budget deficit which has, substantially higher than $1 trillion structural deficit. That is huge. We're struggling with the amount of borrowing that we need to accomplish to fund that deficit. We're spending money at an accelerated pace relative to what we're taking in, and that creates imbalances of its own that, to be honest with you, has made monetary policy that much more difficult. And the net result is, this is a two-policy program. And one side is clearly not doing its job on controlling inflation, so the other side needs to and should.
And Stephen, when you look at some of the factors that are outside of the Fed's control, when you look at a still very tight labor market as well and see some of this wage growth here, what are some of the key things that you should be watching for that are outside of the Fed's control that are also contributing to this?
Well, I think the answer is very, very simple. The fiscal policy adjustments that are taking place, the administration's backing of very, very large union-related contract settlements, and the pro-labor component of this administration is, again, also making the job harder for the Federal Reserve to do what it needs to do. So the reality is, you've got this conflict that's going on between policy approaches, and the net result of that is basically a higher for longer interest rate environment.
Stephen, we'll leave it there. Thank you so much, Stephen Judo. Good stuff. It's good to hear sometimes a bit of a contrary opinion, so we always appreciate that. Stephen Judo of Mizuho Securities, U.S. Chief Economist. We've got much more markets action coming up. You're watching Yahoo Finance. We've seen the S&P 500 pull back a little bit from its highs, around 2.5% or so. How deep do you think that drop could be?
Yeah, if you'd asked me a couple months ago, could we get back to the lows that we saw at the end of last year? I'd say maybe. I don't think that's going to happen now. Maybe another 5% pullback or so to consolidation phase, maybe around 4,300 on the S&P.
According to the Wall Street Journal, Amazon is set to cut 27 of its 30 clothing brands in an effort to combat rising costs and also keep FTC scrutiny down. The big retailer will jettison brands such as Goodthreads and Lark & Row, while they will only keep Amazon Essentials, Amazon Collection, and Amazon Aware. And this is despite a strong showing in its second quarter earnings that came out last week. So how can we understand this shift in strategy, and what does it mean for the retail sector as we see more of the big box retailers release their earnings next week? Well, we're joined now by the Wall Street Journal reporter who broke that Amazon exclusive, Dana Mattioli, as well as tech business journalist and author of Winner Sells All, Amazon, Walmart, and the Ballet for Our Wallets, author Jason Del Rey, to discuss those very questions. Good to have you both on the show. So, Dana, I want to start with you here. This balance between some of this pressure ahead of perhaps some from the FTC versus really getting rid of some of the less profitable parts of Amazon's business here when it comes to retail. How much of that balance was about one versus the other?
You know, I think it's both things at play, and there is some correlation here. The private brands business has been a small part of Amazon's business, but a source of major scrutiny from regulators. They have just been hammered by different regulators around the world about how they're using seller data to create these brands. And for a while, those brands had a leg up on different placements on Amazon.com in search that made them sell really well. Well, once that scrutiny started setting in, they stopped doing that. And a lot of their own products sat on the shelves collecting dust, making them unprofitable. So they're very much linked. This is a business decision, but it would also probably take some scrutiny off the table as well.
And I'm curious, Jason, what your take is on what shape that scrutiny is going to take and how much of a problem it's going to be for Amazon, particularly given that they are taking steps like the one that Dana reported on.
Yeah, I think, for sure, we all expect, Dana's reported on it, other reporters, an FTC antitrust lawsuit to be filed in the next month or so. And, frankly, I don't think it had to be this way. I think Amazon was super aggressive in their use of seller data over the years, in the promotion of their in-house brands, to a point where it felt and seemed to many sellers as unfair. And, they also had a really combative stance in Washington, D.C. over the last few years, both with regulators and Congress. And so, we may look back a decade from now and say it didn't have to be this way. They could have a multi-year lawsuit ahead of them. And while they have many deep funds to fight against the FTC, I don't think that's good for anyone who cares about the future of this business.
And so, Dana, as we think about the brands that they are dropping here, this is private label furniture brands, phasing out as well of some of the kind of clothing brands that they have too. When we think about the different markets that they have tried to play, I mean, does this set up for any other kind of pullback of other brands that Amazon has as they're facing some of the larger regulatory concerns, and as there had already been within DC, many calls to break up a company as large as Amazon?
Yeah, so they're going from 45 in-house brands with 245,000 products, so a massive business in terms of the number of products, to fewer than 20, and they're getting rid of almost 30 just in clothing. So I think, when I spoke to sellers yesterday, once they read the news, they were relieved because they were, having to compete with Amazon, which is sort of like the house casino. They own the platform, they run the platform, they compete on the platform, they have an edge on the platform. So it really made it hard for these sellers to compete with them. So I think there was a sigh of relief there, but will it be enough to appease regulators? I doubt it.
And so, Jason, I want to ask you about then this battle for consumers' wallets here. As retailers are trying to get really a handle on what consumers want, what they're willing to spend more on, how they're willing to pull back, and sort of brand loyalty as well. When you pit an Amazon, just in the retail space at least, against a Walmart, how are they now positioned?
Yeah, I think it depends on which category you're talking about. So in the grocery category, despite Amazon's acquisition of Whole Foods in 2017, they've struggled mightily. They've paused the expansion of their fresh stores. They've now reinvented a few of them to see if the new model works. But they really have struggled there. And that has allowed Walmart to continue to sort of make up ground in digital when it comes to grocery. They've really sped up this omni-channel transformation under Doug McMillon McMillan, the CEO, over the last few years. And they have a real opening to continue to make things really convenient for customers and perhaps cut a little bit into Amazon's market share. That said, Amazon continues to increase the number of geographies where overnight Prime delivery is available. And that puts a lot more pressure on Walmart to speed up this omni-channel digital transformation that they've been undergoing for years now.
Yeah, it's very interesting, sort of the two companies as foils, if you will, right, for each other. So Dana, when you look at Walmart's pending report here, and what has it also sort of sharpened Amazon to some degree? And I thought it was so fascinating in Amazon's earnings that we did see what seemed like an uptick in demand for e-commerce on that side.
Yeah, I think for a while, Amazon was a little complacent in the fact that it was the fastest e-commerce player in town in terms of shipments. But what you've seen is that Walmart and Target have all gotten faster. And that's part of, to Jason's point, that Amazon has had to roll out these new centers that are one-day delivery, and they're super fast. And they've had to make a big investment there because two-day shipping has become a little bit commoditized. It's not the be-all end-all that it used to be. So they have to stay ahead of everyone else, even if it means lots of investments in supply chain.
And then, Jason, just lastly, while we have you, we think about how all of these players have tried to make sure that they've got some sort of membership program, a tier that Amazon had really kind of, for the retail environment, pioneered and made sure that they see higher ticket or higher purchases or propensity to spend by people who have those subscriptions. Has that played out as intended for some of the other players that we're going to hear from in this retail part of the earnings season?
Yeah, Walmart specifically, they have Walmart Plus, and in my book, I spoke to their former e-commerce chief, Mark Laurie, and he knew and told executives internally, we need to steal some Prime customers away if we're going to make up a lot of ground in the digital world, which in many ways is the future of the retail industry. And so Walmart's, they have a good program now in Walmart Plus. They're rolling out new perks. But when I sat down with Doug McMillan, the CEO, last year, he wanted the press and Wall Street to be very conservative in their expectations of Walmart Plus. I don't know. He just said that's only one thing we're doing. We're doing many new things. That's one. I don't know if that signaled it wasn't going as well as planned, or that they really are investing in advertising and logistics services and fulfillment services, much in the Amazon playbook. But again, I think it's going all right on their front, and they do need to steal some Prime customers if the program is going to be really successful long term.
All right, we will see exactly how that success has played out over the most recent quarter when Walmart does report. That just days away from now, but we have a weekend between now and then. Wall Street reporter Dana Mattioli and tech business journalist and author of Winner Sells All, Amazon, Walmart, and the Ballet for Our Wallets, author Jason Del Rey. Thank you both for joining us here. We appreciate it.
Thanks.
Thanks. All your markets action straight ahead, everyone. Stay tuned. You're watching Yahoo Finance.
We always like to ask people who come into town from out of town kind of about the vibe, right? Because most of the people we talk to are based here in New York. You, of course, are based in Houston, Texas.
Right.
What are you hearing from clients right now that might be different than what we're hearing, say, on the coasts?
Well, I think it's more of a question of the conservative nature of their portfolios, the risk that they're willing to take. I feel like there's some differences there. Some people that see more of a recession that's coming, other people that feel we're having a soft landing. There is a dichotomy going on there between clients, and it affects the risk that they're willing to take in their portfolios.
We're watching another fashion industry blockbuster unfold. Tapestry is betting big on Capri Holdings. Tapestry announced it will spend $8.5 billion to buy its longtime rival. The transaction will add new brands to its portfolio like Versace, Michael Kors, and Jimmy Choo. So what does this all mean for Tapestry? And how does it fit into the larger M&A action we've been seeing this year, of course, in retail? Joanne Crevoiserat joins us now, Tapestry CEO. Joanne, great to see you here. Congrats on this deal. I know things like this do not happen overnight. Now, the market reaction was tough. I mean, shares of Tapestry went down almost 16% on the deal. What did the market not get, Joanne? What did they miss?
Well, I'll start by saying first, it's great to see you, Brian. And I know you love brands. So this is a very attractive combination. We're establishing a powerful global house of iconic fashion brands, uniting, as you said, Coach, Kate Spade, and Stuart Weitzman with Versace, Jimmy Choo, and Michael Kors. And we're excited about bringing these brands together because of the compelling financial opportunity. There's excellent strategic fit. It's immediately accretive, and we see significant runway beyond just the initial combination. And I think we're confident that investors will see this compelling opportunity. This is a story to watch, Brian.
What makes the transaction so compelling?
Well, again, it is about the strategic fit. We're thinking long-term about our business, and the strategic fit of this transaction, it builds our portfolio in a great category. We play in a resilient $200 billion luxury market that includes handbags, footwear, and apparel. And these brands are incredibly, they're distinctive in that market, but they're also complementary. If you think about our two businesses, this deepens our access to a higher end luxury consumer that is quite resilient. There's geographic diversification here, where the Capri business has a relatively higher penetration in Europe. Our business is relatively higher penetration in Asia. And it broadens our product offering because the product categories are also complementary, where the Capri business has a higher penetration in lifestyle categories like footwear and apparel, and we see opportunity to grow those categories across our portfolio. So on a number of different levels, these businesses are complementary. And then we believe that we have an opportunity to leverage the Tapestry platform to drive a direct-to-consumer opportunity. We've built this strong consumer engagement platform and elevated our direct business, and we think that applies as well to the Capri businesses.
I've been covering your company for a while, Joanne. Going back to it was just called Coach, and I remember that 2017 acquisition of Kate Spade. This was before you. There were challenges integrating that business, again, before you. What is the institutional knowledge inside of Tapestry to better integrate a company like a Capri, which is a lot bigger than Capri? Which is a lot bigger than what you bought a couple years ago in Kate Spade.
Exactly. Well, we have experience in integrating, and I would say that we've learned a lot over those years, right? And the importance and the things that are important that we've learned, the importance of clarifying the brand positioning, not walking away from the unique and distinctive aspects of each of these brands. These brands are iconic, and they have, we fielded a lot of research in this in the process. They are strong brands. They're well positioned in attractive markets and market segments. So our first learning has been clarifying the brand positioning. And in our transformation over the last 3 years, we've done exactly that across our brands, clarifying that brand positioning and crystallizing the target consumer to make sure that we're strengthening our execution behind the product offering and the experiences for that target consumer. We've also strengthened our teams and ways of working, embedding data and analytics. We've spent a lot of time, I know, over the years talking about that, Brian, embedding those analytics in the hands of decision makers to make our business better, move faster, and more responsive to consumer data that we have. And we've invested in brand building activities over the past few years. We've more than doubled our marketing spend. So as we work to engage consumers and integrate these brands, it will be with that focus on continuing to build the brands. We're also going to be quite choiceful about where we decide to integrate and where we don't, knowing that there are some places that it makes sense to have a lighter touch. And businesses like Versace, that's playing in a different space with a higher end consumer where we don't have the experience or scale, the integration will be a lighter touch. And in the places where we have experience and scale, we'll bring that scale to benefit the acquired brands.
One thing that I think the street is realizing today, and I don't think they realized it yesterday, Joanne, is the international play here. It seems like there's going to be a new unlock or new areas of growth, notably in Asia, where Tapestry and Coach have really had a strong position. Does this better allow you to compete with a Louis Vuitton in those high growth emerging markets?
Well, we think there are opportunities around the world with this this combination. You know, they have a relatively stronger business in Europe, where we are also relatively underpenetrated. So we think there are opportunities on both sides. We can learn from the Capri brands, and they can learn from us in Asia, to your point, where we've had more success and we have higher penetration. Overall, this combination provides more balance and diversification around the world, which is great for our business. We have seen the importance of global diversification over the last 3 years. We've seen different parts and regions of the company accelerate at different rates and face challenges at different rates. And that's been really the underpinning of our ability to deliver consistent, strong results quarter after quarter through a very tumultuous time, because we have this global footprint and diversification. And this combination only adds to that.
I think one of the other reactions here, Joanne, is that Capri was struggling. You know, its shares were underperforming yours the past year ahead of this deal. What do you have to fix there?
You know, if I take a step back and talk about our overall vision, it's taking iconic brands with true heritage and design and craftsmanship. And there aren't a lot of those kinds of brands in the market. So I do think it's important to take a minute and just appreciate the quality of the brands that we're bringing on. But when you combine those quality, high quality, iconic brands and put them on this modern consumer engagement platform, that's where we can deliver more innovation, more connectivity with consumers, and more relevance, which, you know, we see that as luxury at its best. And that is really the power of this combination. And I think why we're so excited about the acquisition.
Before I let you go, Joanne, on a personal note, what does doing a deal like this mean to you? I go back, I originally met you when you were at Abercrombie & Fitch. You helped turn the finances around there. You came here really under a tough situation initially as the CFO, quickly rose the ranks to CEO. You've turned around this company. What is it like to pull a trigger on probably one of the biggest transformational deals in retail in the past 5 years?
I see incredible potential. And the thing that gives me most energy and most gratification is seeing our teams win. We have such quality teams around the world that it's harnessing the power of our teams that has really been the underpinning of our success. It's very clear in the market. I've been in this business, Brian, even before those experiences, since I graduated from college, 35 years. It's moved and changed a lot. The focus on the consumer and the agility that is needed to really engage consumers today, those are the capabilities that we're building. And I get a lot of gratification from harnessing the energy and the passion of, now we'll have 33,000 team members across the globe. And I think that's a powerful opportunity, one that we don't take lightly, but I think it will solidify our growth going forward.
Well, good luck on this integration. Thanks for giving Yahoo Finance some time. We look forward to following this journey. Joanne Krevoiserat, good to see you. Have a good week, and we'll talk to you soon.
Thanks, Brian.
Appreciate it. All right, more markets analysis straight ahead on this Friday morning. We'll be right back.
It's been a wild year in the retail space. Inflation has dominated the headlines, causing shoppers to spend more cautiously.
As a result, profits at major retailers such as Walmart, Target, and others have come under pressure.
Organized crime and a growing list of bankruptcies also continue to cast a shadow over the entire industry.
But what does this all mean for the future of the sector? Should investors dive in or steer clear of retail stocks?
We'll bring you key analysis and hear from some of the biggest names in the industry to answer key questions.
Who is the consumer visiting? What can retailers do to stop the rise in theft? Are more bankruptcies on the horizon? And where does AI fit into it all? It's all part of our week-long special, Retail Evolution, The New Era, starting Monday, August 14th, right here on Yahoo Finance. You won't want to miss it.
The box office has been booming since the release of Barbie and Oppenheimer, or Barbenheimer, mid-July, breathing new life into moviegoers. But how does that impact advertising? Well, National CineMedia is taking a new approach, opting to shift to a programmatic selling structure for movie screen inventory. Tom Lazinski, National CineMedia CEO, joins us now. So, Tom, talk about this shift here and how we'd actually see it play out in real time when you think of customer data and how it would be then sort of transferred to or sold to third parties, and then how moviegoers would actually see this experience.
Well, for the consumer itself, it would be fairly transparent. What we've been building is a very large database, and probably the largest cinema movie database available. And ultimately, what every brand wants is they want to know exactly who's in their theater and whether they're targeting the people that they're looking for. We're known for reaching 18 to 34-year-olds. There's probably no better delivery system in the world for reaching young people in movie theaters today compared to television or even in digital. So what we wanted to do was marry that great young demo to a really cinematic experience, 50-foot screen, and then have the data and the ability to do all the attribution studies that our clients want. We've been very fortunate. July was one of the best months in the history of the movie business, in fact, the biggest July since 2016. And during that period of time, 125 million people actually were in movie theaters, and National CineMedia being the leader in the space, we've delivered, 70% of those. The schedule you have up right now shows a really interesting intention study that we did. Literally 97% of people watch cinema ads, and that compares very favorably to linear television, sports, even YouTube, TikTok, Facebook, where we outperform most of those partners by at least 2 to 1. So it's a really interesting comeback story. Just as the movie theaters have come back, cinema advertising is coming back as well. So we're excited about the future of this business. The movie business has been under a lot of duress during COVID. And we finally see the life back in the business this summer with Barbenheimer, which seems to have been quite the story for everyone.
Yeah, I mean, look, it got me dressed up to go to the theaters, Tom, so that was a success as well as just being able to see the movie and kind of participate in that. But then you think about what beyond Barbenheimer as well, and the fanfare, the amount of foot traffic that's going into the theaters. How do you continue to sell to potential advertisers and marketers that the CPMs should still be that valuable moving out of a major wave of moviegoers like we've seen over the summer?
Well, as we sell advertising, we lay a slate out for our brands and advertisers. Every month, every week, there's some movie and some demographic that's interesting to an advertiser. And what was interesting to Barbie might have been different to someone who was searching, the Oppenheimer demographic. So as we lay out our schedule, and right in the middle of the upfronts right now, which are looking actually pretty good, there's always a movie in any given flight. And typically our brands buy by the week. And they can often buy all the movies in the theaters. They aren't just buying just Barbie and Oppenheimer. They're buying every screen in a multiplex. So we've never had an issue, honestly, attracting advertisers around the year. Obviously, there's peaks in the summer and there's peaks in the fall, November, December period. But generally speaking, this is a business where we can always drive young people into the theater. And I think as brands keep searching and searching for young people, they can't find them on TV anymore. They often are unreliably found in digital platforms. But we know when they're in front of a 50-foot screen that they're going to see our ad and it's going to have a lot of impact. And most importantly, we have the ability to retarget them after they leave the theater, whether it's on their mobile phone or through a digital device. So we can really deliver end to end before, during, and after the moviegoer that is often so desirable by advertisers.
So, and Tom, as you guys exit bankruptcy and amidst this restructuring, do you expect to sort of follow the wave of the return to the theater? In other words, did the restructuring have to do with the pandemic and people not being in theaters? And now, as you also pivot to programmatic and also bet on, sustainable return to theater, that's the sort of prospect here?
Let me sort of cover all those questions at once. So
Sorry.
There is a high correlation between admissions and box office and the way we deliver advertising. You see those results in advertising often later on because most advertising is bought in the upfront market and bought often a year ahead of time. So what's being sold in the marketplace today is often the futures market of advertising, which is anywhere from 9 to 12 months from now. And then there's also, of course, a scatter market, which was relatively weak sort of lately. So we look at our recovery story as being similar to what's happening on the exhibition side, whether it's at AMC or Cinemark or Regal or some of the big public traded companies. But we tend to have a much better story in that our margin structure is significantly better than that. And the advertising business tends to be less volatile than the exhibition business. And, you know, we're combining this with our digital platforms. We announced programmatic as being a new initiative for us to reach a whole nother type of advertiser. So we look at us as a recovery stock that many people haven't discovered yet. We officially emerged on Monday. We're one of the few, if you know, any companies on the Nasdaq with truly no debt. So we have the ability to reinvest in our company. And this is a very high margin business that delivers, you know, 80% of its free cash flow into EBITDA. Historically has been a high performing stock. Obviously, the capital structure was a problem for almost 3 years during COVID. And now that that's behind us, we sort of look at this as another opportunity to take a really good ad product, high margin, interesting product for consumers and investors, and then reinvigorate it potentially with additional capital.
With that additional capital, do you think that you'll need to tap even more kind of resources to increase the liquidity for the company and continue investing?
I think the thing for us to do is, you know, we have to stabilize, obviously, our core business, which will require investing in our current infrastructure and current people set up. But we are going to look to additionally invest in data and analytics, which we've invested a lot in over the last several years. And we may start looking at other adjacent opportunities to reach cinema goers. It's a very unusual captive audience to have somebody in a movie theater running an ad. And that young demographic is obviously very appealing. If we can find related businesses or additional opportunities to sell to those same types of consumers, we would certainly do that. We're in a really unique position to obviously reward investors based on our capital structure, our margins, and the potential to grow the business.
Tom, we got to go. What is the most compelling non-theater, non-cinema opportunity right now?
I think probably digital out of home is. You know, we are out and about all the time going to movie theaters. Often those are in malls and places where we can deliver additional advertising to people coming and going. So I see that as a really important adjacency. So I appreciate all the time and effort, but I just want to leave everybody with, you know, get a chance, go to the movies this summer if you haven't gone. It's a great experience, and it was proven out in July with Barbie and Oppenheimer.
I have gone, and I got dressed up for the occasion, Tom. It was fun. It was really.
It was fun. You forget how much fun it is, because for 2 years in COVID, we never got to go, and it's great to be back in the theaters.
Absolutely. Well, Tom, thanks for taking the time here with us today. Tom Lisinski, who is the National Cinemedia CEO. We appreciate you joining on Yahoo Finance here with us this morning.
Thank you for having me. Appreciate it.
Certainly. All your markets action straight ahead. Stay tuned. You're watching Yahoo Finance.
We've seen the S&P 500 pull back a little bit from its highs, around 2.5% or so. How deep do you think that drop could be?
Yeah, you know, if you'd asked me a couple months ago, could we get back to the lows that we saw at the end of last year? I'd say maybe. I don't think that's going to happen now. Maybe another 5% pullback or so to consolidation phase, maybe around 4,300 on the S&P.
Welcome back. The big pharma battle escalates. The Supreme Court has pressed pause on Purdue Pharma's bankruptcy reorganization after President Biden's objections over protections in the place for the Sackler family. Yahoo Finance's Anjali Kamlani has been tracking this. She's got the details. Hey, Anjali.
Hey, Brad. Well, it's good you brought up President Trump because this does go back to that time. But let's fast forward to what happened just now. The U.S. Supreme Court taking a look at what the bankruptcy deal would entail. That includes $6 billion from Purdue Pharma to the victims of the opioid epidemic. The hearing date for this is going to be in December. So that kind of draws out what seemed like it had been sort of a concluded episode in this saga. Purdue Pharma, of course, owned by the Sackler family. Formerly, they did withdraw billions of dollars, up to $11 billion back in 2020, and have also been seeking protection or indemnity against any future lawsuits. And that's the point of contention for the U.S. government, saying that they don't see that as a sort of a fair way to go about this, that it is an abuse of the bankruptcy system. And that's been the sort of underpinning point that started this new court decision. And so we're going to have to wait to hear and see how this all plays out. It does have some potential impact on other similar bankruptcy filings by healthcare companies and other companies, 3M and Johnson & Johnson, for example. We know that Johnson & Johnson does have a bankruptcy filing going on for its talc litigation, and similarly has been holding it off sort of in a separate entity. So while it's not quite exactly the same as this Purdue case, it could potentially have some implications for those others, the other one being 3M as well. So this is, what experts are saying. That's why all eyes are on this. There has been some opposition from the victims against this new position, and we are going to just have to wait till December to hear the arguments in the Supreme Court, and then a decision likely early next year.
All right, Yahoo Finance's own Anjali Kamlani. Thanks so much, Anjali, for tracking all this, bringing it to our attention. Everyone, we've got all your markets actions straight ahead. Stay tuned. You're watching Yahoo Finance.
What do you think is the biggest risk for stocks right now?
I think bond yields are one of the biggest risks. If they go too high, that's going to cause a lot of volatility. But I think if the Fed becomes more hawkish than what people are anticipating, that's going to be a trigger for the economy.
The LK99 superconductor has been getting a lot of buzz lately. It took social media by storm. It grabbed the attention of scientists and journalists alike as a potential huge scientific breakthrough. What is it? Well, the basic idea, superconductivity, the ability of certain materials to conduct electricity without energy loss when cooled below a critical temperature. The hype around this LK99 substance was that it was the first room temperature superconductor. Such a discovery would be a game changer, but doubt was thrown on it this week when various research groups released studies countering claims originally made about the substance. Well, yesterday I spoke with the CEO of American Superconductor, Daniel McGann. The company saw its shares spike along with various others around this hype, this despite not having a direct link to the LK99.
We feel like we've transitioned from being a material science company, which is really what we were at our founding, to a manufacturer of completely integrated systems. So any technical advances in this field that can really further our offerings, we welcome, right? So I think one of the big parts of the news is that if there are technological advances in our space, it's only going to benefit us because it's going to spark people thinking about what the future could be. And really what we're capable of doing is delivering what's possible today. As a commercial company, as a public company, we plan to continue to maintain this position, but we need to be able to develop the future, but be able to deliver the present. And a lot of what we do is translating that, what used to be science fiction. If you go back you look at any science fiction book that talks about how do we do interplanetary travel, it's a superconductor drive. If you look at even what Tom Clancy wrote with The Hunt for Red October and the drive that was in that submarine, it's a superconductor drive. If you go back to the very founding of the company back in the mid-'80s, it was very similar in that there was a whole brand new set of materials that were discovered and people were trying to figure out how they were useful. And that took a little bit of time. And then it took a much longer time and a pretty good amount of money to figure out how to make them. Right. And then what we've figured out recently, and really since I met you, I can give you responsibility for it, that we've been able to commercialize finally. It's taken a long time for this company. We've been in business more than 3 decades, and we're now seeing permanent installations on the grid and in Navy ships of superconductor driven systems. So there's a huge future, I think, in superconductivity. And I think any and all investment that helps to try to improve how the world's going to move, particularly as we have the mindset towards, how do we manage the change in the climate and how do we decarbonize the economy, that our company is really at the center of how do we make that happen. And superconductor is a piece, and other types of superconductors in the future could be pieces as well.
So again, just to sort of differentiate here. So a superconductor, I guess in its simplest form, is something that conducts electricity without energy loss. That's the sort of idealized version. Or the idealized version would be one that you didn't need to do anything else to it. It would just be able to do that by virtue of its innate properties. And that's allegedly what this thing was supposed to do, this thing in Korea, but it probably doesn't. So the superconductors that are in real life, in reality, that you guys are using in your applications, what are they? In other words, what has to be done to them in order for them to perform without this energy loss that we're talking about?
Yeah, I mean, the two main areas that we've seen commercialization is what we've done and what the medical industry's done with MRI. And to give you kind of to compare and contrast them and the view of the technology in the future, the MRI machine, if you've ever had one, has very significant amount of infrastructure. And a lot of that infrastructure is be able to manage and cool the magnet. So if I have a conductor, I can do 2 things it's really useful for. One, move current through it to get it from point A to point B, or move current through it to create a magnetic field. So we talked about what we do with the Navy. That's the feature set that we're adding there. The same thing with an MRI magnet. You're trying to use the superconductor to have high energy dense, very specific targeted magnetic fields to be able to investigate what's in the body without direct contact. The load for the cooling apparatus in the hospital is quite significant. In our case, it's about a 20th. So the load of what we have to deliver to be able to cool the superconductor to get it to the point it can produce the magnetic field we want or move power without loss, that's a piece of the technology. Where people wanted to head is, can we do that with lower load and eventually no load? And I think that certainly that's the pathway. But it seems like, this has always been a chase for, just like in fusion, they want to talk about different ways to do nuclear fusion. In superconductivity, there's been that as well. And then there's been other discoveries of other superconductors. Some of the challenges are with other materials is they're pretty significantly carcinogenic. So the last thing you want to do is to try to solve what we think is a noble and important problem for humanity, to be able to manage climate and carbon. You don't want to do that by using, known carcinogens, right? So there's a certain piece of this that you have to go through a screen on what the material is, how would eventually you be able to make it, how would you format it, how would you make a system. And our company has done is we understand full end to end. So if there needs to be a change in one piece of that end to end, we're able to adapt, adopt, and hopefully exploit it in the market and use it as competitive advantage.
So as all of this discussion was going on and understanding now how it's used in the real world versus what was going on with this research, we did see some interesting activity in your stock, right? Because people saw the word superconductor, I think, maybe, and, bid up your shares. Now, how do you think about that from a management perspective when something like that happens?
Well, what I think the good sign of it is that through the media cycle that we've gone through and through the run up in the stock and the heavily increase in the volume, I think a lot of people now understand maybe what a superconductor is, what it's useful for. I think a lot of people maybe have maybe a different imagination set where they can think about a different possible future. And I think, our role as a corporation is to make sure we're part of that and helping to move that forward. So I think it's an educational moment for many people. I think, as you said, a lot of people were looking for companies that were involved in superconductivity, and we are, the main one. We are at the forefront of the technology on every level. So, and these things may happen again, right? Science makes progress, but then science has to be validated, has to be peer reviewed, has to be understood, replicated, all those things. And then once that happens, there's a whole industrial piece to it. And how do you make it over and over again? How do you make it useful? And then how do you systematize it in something that somebody can buy, which takes time. And that's really the history of our company. That's what we've been at this for a long time. And it's taken a lot of effort, a lot of blood, sweat, and tears and shareholder investment to get us to where we are. And that's the good news in the call. And partly why I'm real excited today. It has nothing to do with the stock and scientific announcements. We've now proven out what I've been talking about for about the past 2 years in the transition in the company, where we actually guided for our next quarter that we're in a position we may generate positive operating cash, which is huge news for us. We've never done that before.
That was American Superconductor CEO Daniel McGahn reacting to some of the hype around the LK99 superconductor. He talked about also the sustainability of that cash generation. Let's get a little more into what LK99 is, or at least what it could have been, and why that matters. So we turn to our tech reporter here at Yahoo Finance, Dan Howley. Dan, what do we need to know about this story and why there was so much excitement around it?
Yeah, Julie, this is basically, it came out of South Korea's Quantum Energy Research Center. The folks that published this have been criticized for not waiting for the paper to be peer reviewed. This was basically just, their kind of work and what they say they did. The reason why a superconductor could be huge at room temperature is because, as Dan was just saying, this stuff needs to be incredibly cold to work. You need if you stuck your hand anywhere near the temperatures that these need to function at, even currently the ones that are used in, MRIs, it's like, liquid nitrogen, and your hand would basically fall off from being frozen. So it's not as though you can use these right now at room temperature. And so being able to do that would be wild. And so, when you talk about this no resistance kind of material, when you get resistance in electronics, it comes out in the form of heat. So when your computer heats up, when your TV heats up, you touch your phone when it's charging, it's getting warmed up, lights, things like that. They all heat up because of the resistance in the electronics. And so a superconducting material eliminates that. So it would allow for far more efficient grids. Currently, these technologies, Dan mentioned this, are used in MRIs, They're used in cell towers. There's experiments to see how they can work on wind turbines, maglev trains. So the idea here would be we have this infinitely more efficient, perfectly efficient conducting material that you could then put into electronics. You could put into the grid. You can basically anything that's electrified, you can use, and then potentially have things like flying cars, or maybe not necessarily flying, but levitating cars, which is still better than, I guess, being on the road. But it's still something that really is a ways off, and it's looking more and more like this LK99 is not exactly what it was originally made out to be.
Right, but it shows that there's a lot of hope, at least around this. Dan Howley, thank you so much. And then there is the stock side of all of this. Yahoo Finance Chair Blickry is with me to explain how this hype manifested itself.
Yes.
It was sort of a blip, but it was a really interesting blip to watch.
And fun, too, because this kind of takes me back to the time back in 1989. I was just a kid, and cold fusion was the rage. And that was an experiment at the time done by some scientists. It was not able to be reproduced, but as the public imagination just ran wild with the possibilities. Now, this time around, I'm not really seeing a wholesale move of money into what people might have expected. U.S. companies, at least, would have benefited from this, including Super Microcomputer. I'll get to that in a second, but let me just go over some of the Korean stocks that were immediately affected. Here we have Duksung, and I'm going to put a chart on here. This is a 2-month chart. This gives a pretty good idea. What does this look like? This looks like classic meme short covering action right here. Easy come, easy go. I'm going to show you another company. Here's Mobis. That's up 7% over 2 months, but basically crashed and gave up almost all of the gains since it made this run up. And here's another one, Sunam. And let's see if we can get that up. Not sure if that's going to participate here with me. There we go. Looks pretty much the same. And now let me show you why Super Microcomputer in the US is a little bit different. I think this was just AI hype, and that was the fuel for this rise up. Then they had their earnings call. There was a little bit of disappointment with respect to their forward guidance. And this is just a normal backing off from an existing trend. That doesn't look like this meme type action that we're seeing in some of these other names. What does this look like to me? This reminds me of, guess what? Tupperware. Recent chart here we have in Tupperware, very meme-ish, Yellow Corporation filing for bankruptcy, the trucking company in the US, and also Sirius Holdings also under bankruptcy threat. So all of this just says there is some hot money looking for an out and an outlet. Having a little fun here, but I didn't see anything that was really committing to the materials sector, for instance.
Yes, gotcha. All right. It's the thirsty cash. It harkens back to
thirsty
those
cash.
days. Jared, thank you so much. That's it for us. So we'll have more superconductor talk next week in between retail results. Don't miss it.